Something is gonna break. If you want to find out whether it's to the upside or to the downside, enjoy this video. See you in a second.
Holy fucking shit, it's a dinosaur. Jesus Christ, what the fuck? Oh my fucking god, fucking dinosaurs, holy shit, what the...
Welcome to the latest edition of Grey Market Talk with Nick and Thorsten. And today my daughter gave me advice how to, pimp up the YouTube channel. And he said, you need a thumbnail. So I've asked the AI to produce nice pictures of Nick and I, enhanced through artificial intelligence. I think that's what we did. And you've seen it already. We'll keep doing this and don't want to procrastinate too long. What are we going to talk about? That I gave it the title, Something's Gonna Break. And I think something is gonna break. We just haven't established from which direction the break is gonna come. And is it to the upside or to the downside? And we want to elaborate that today. Who better to talk to something about that, like a Greek Cypriot with a British passport, being married to a German who loves Italian food. Let me introduce Nick into the conversation, because I think the big hit will come out of the bond market. What we see at the moment, in my amateur bond trader perception, is something's going on there, and I can't quite put my hand on it. The only thing I see on the equity side, the equity market seems to completely ignore these enormous pressure points that they're building up on each corners. And that's what I want to dive into it. And obviously, I'll start with a Greek question first. Nick, I came across the internet, a lot of articles, and a lot of people talking about, apparently hedge funds are shorting the shit out of Greek government bonds. What's going on there?
Well, then you have to speak to the hedge funds, but I have to say the
aren't you advising these guys?
I wish the if something was going on there, you'd see it in the price, and I don't see it in the price, and so for that reason, people want to make their play somewhere, look at weak points in the market. Perhaps it's cheap to sell Greece. There's some elections, why not? It's a cheap trade, but I've been asked this question, not about Greece, but constantly about Italy. Every client I speak to is, when's Italy going to break? And we're really worried about Italy. And I say, forget these things. They're not on the radar. That's not what it's about. And I think there is a tendency for everybody to look for cheap shorts at the end of the day, cheap hedges on positions, and they keep potentially looking in the wrong spots. It's like these, very low priced options. They're cheap, but if you keep doing it, it gets really expensive in the long run. So I don't think the story is there. We're always going to be surprised by these. Suddenly something is there, but I don't see it, frankly. People are also worried about Turkey and the Turkish yield situation, the bond situation, the currency situation, who's going to run the show in Turkey. And what you saw in the last couple of weeks, actually a tendency for the opposition leader to be the favorite candidate. What actually happened, yields actually rose by about 200 basis points in Turkey. And then because the opinion polls were in the favor of the opposition, then they were totally wrong. We know about opinion polls. They are always wrong. Bang, what happened? And you had a massive reversal in yields in Turkey. People keep looking for stuff. And then you've got to say, well, okay, if something's going to break in Greece, or if something's going to break in Turkey, let's have a look at what was going on in the currency. If the opposition leader really was the best candidate, for example, in Turkey, and the bond yields were going up, well, why was the currency getting sold off? So I don't think this whole picture is particularly well-rounded, and these are necessarily the best things to play right now. I guess people are saying, well, perhaps we found the next Venezuela or the next Argentina, let's go for it. Great, let's just sell some Turkey bonds. And then they were wrong, when the election results came out. Perhaps they're trying the same with Greece, but I would say wrong thing to say, famous large words, but nothing to see here. And
Argentina came in after we concluded recording last week with a surprise interest rate hike to, what was it, 97%? Something like that. Yeah. Do you know there's still a 100-year bond out there? People were foaming with their mouths. I don't know, 5-6 years ago, everybody wanted to have this 100-year Argentina bond. What is that trading now at one?
Or was it?
Yeah, it was Argentina first. Austria came first. Austria is a real country, obviously, but Argentina is a real country as well, but with a very, very destabilized political system. So good investors, bad investors. You said there's nothing to see here, and that is one of the points again. On Bloomberg this week, I came across a beautiful graph showing how far Italy is away from being rated as junk. And we are one notch away in the category from being rated as junk by Moody's, S&P, and even Fitch. There was a meeting or planned a meeting, a reassessment meeting by Moody's on Friday to reassess or give a statement about Italy. And I had a little bit of a chuckle because Moody's simply canceled the meeting. And I said to my wife, oh, that is interesting. Eh? If you don't want to really downgrade somebody, but you also don't want to lie about the real situation, what are you going to do? You cancel the meeting. That would have been my take on this whole thing. And Mrs. Maloney, she still is being owed something about 200 billion out of the Corona funds, which haven't been spent in Italy. So as long as she's a sensible conservative and behaves according to the European Union, she will get that money without any doubt. The moment she pipes up with some weirdo fantasies, which, Italy is prone to, right, historically, things could change. But is there a take from your side with what will happen, or explain it to me like this, the mechanics of portfolio managers, investment managers? You have government bonds in your portfolio worldwide. What happens if one of the big boys like Italy would suddenly be downgraded to not investment grade anymore? What would you have to do by your internal guidelines, by your statutes, if something like this happens?
Well, that would be dictated to by the, if you like, the governance of that particular fund, or how it is with the client. Either he's accepting non-investment grade debt. Usually, I would say, historically, what's happened is that the majority of clients effectively say that once something is non-investment grade, you get a certain period of time to exit the position. But if you are holding something, right, and you are, managing the risk like this, whether it's not going to be junk, and then suddenly it is junk, well, I think you've done something wrong in the first place. So if you sort of sat with this thing and it's been pretty clear that this thing is going to go, then the most sensible thing for a client to do, for you to do for that particular client, is to say, well, there'll be a better time to actually reinvest this thing. But I'm not going to be one of the mugs who, at the end of the day, when, I've just read a newspaper and it says that they are now downgraded, I better go back to my desk, and then I sell into that major hole where you don't have any ammunition left to buy this thing when it is cheap. You're being sort of pro-cyclical rather than anti-cyclical, and that's the thing, the difference between what I would call a good fund manager and a not so good fund manager.
My question was more
thinking ahead.
There is no automatism in there, because if it's in your statutes and you don't have a choice, you have to do stupid things.
If there are, if you don't have any time, nobody's going to set up such a contract that way. But let's just say, we do not accept for one day a non-investment grade investment in our books, has to go. But if I was the client in that situation, I'd say, well, why'd you wait that late?
Because that reminded me another war story from my past. I don't know whether I've already mentioned it to you, obviously, and I've written an article about it. But LTCM, when LTCM blew up, what was it, 98? I was a young market maker, yeah, didn't have a care in my life, sitting behind my screen, drinking coffees, having banter, and my phone rang. Picked up the phone, and one of my colleagues, who shall not be named, for one of the biggest banks in Europe at the time, said, "Hey, Torsten, I need volatility." Yeah, so he needed Vega to hedge his risk after the volatility spiked up. And I said, "Oh, really?" I knew he needed it because they were selling a lot of products into the market, so they had a short position there. And I said, "So what do you need?" And he said, "Everything you got." And then I said, "So what underlying?" "So whatever you can provide." And I said, "Maturities? Tell me what you have. I take it off your hands." And I started grinning on my side of the phone as well. And I said, "You know, you're an idiot doing that." And he said, "Of course I'm an idiot. I just have the guys in the 3-piece suits standing behind me, yeah, board, who actually is now roaming the trading floors and is telling me we have to hedge our risks. There's contagion in the market. We're gonna get screwed." And I said to him, "You don't mind then if I rip your face off, because, well, my 3-piece suits are also behind us. And if I'm selling volatility at a period like this, we have to make sure at least the price high." I said, yeah, I know I'm an idiot, but I have to. Yeah? That was the same situation. He knew he was doing stupid things. We had reached the peak. I was selling BASF and buyer vols at 55, 60. You know, the most boring shit you had at the time in Germany. But he was forced into this situation. Getting the segue again to Italy. Yes, you're a sensible fund manager. You thought, I have a widespread portfolio of European debt in there, some higher yieldings in there. I don't believe that Italy is really going down the crapper. But then something like this happens, and you're being forced to sell out. Where would your money then flow into? What would happen in the dynamics within the European debt markets? In a case like this, would then the pack hunt for the next weakest link, going after, let's say, Spain or whoever's out there?
Well, I mean, there are two questions there. I mean, what do you do with, obviously, you don't like the collateral, so you're going to have to get into something which is reasonable collateral in Europe. And we saw that before, you know, everyone jumps into the German bond market. Even the Italian banks would be jumping into the German bond market to replace what they've got. So that's the first thing is, you know, there'll be a huge widening of spread, and that will be two ways. One, the Italian bonds will be falling, two, the German bonds will be rallying, and things will move in sympathy. And then the other question you effectively have got in that is, well, once we've solved one problem, where's the next one? And I remember during the Brexit sort of war story time, where you know, we were running our risk before the Brexit, and so out of all UK risk, and then, you know, everyone says, well, okay, that's you know, job done. I said, no, because behind the UK sits Italy, so that's going to be the next shoe to drop. So already now we need to start to be positioning for what's likely to happen with Italy. And so these snowballs, they happen. But if you look around the world today, and do I need to wait for a Moody's to tell me when there is a problem in a country or a company? Usually Moody's are a bit like central bankers. They follow the markets. They're not really the people who tell you what's going on. So it would be the credit default swap market that would be the kind of the first inkling of where you'd see some break points. Yeah, I mean, if Moody's tell you first, you know that you're doing something wrong. So that's really the first thing. If you, as I say, you look around the world, all governments are just blowing their budgets like crazy. You know, they cannot rely on just simply no central bank using their balance sheet. So QT, quantitative tightening, reducing their balance sheet, not buying government bonds, and allowing the market to go and buy those government bonds. It's just not feasible with the amount of debt out there. So, you know, where is the bond vigilante? So if you think things were going to break, you know, you would still be short JGBs from 20 years ago, and probably not wearing a nice shirt like you are today. So the world is built now. It's so differently, and And I would simply say that looking forward, let's just one step back. So you said, okay, there was something in the news about Greece and, you know, Moody's and Italy and whatever else. And last week you asked me about oil and copper, and, you know, there's obviously some stuff going on. And, you know, I probably faffed around with the answer in some way and didn't really answer it properly. The reason I didn't answer it properly is because they're not relevant. They're not relevant today. And, you know, we have to follow what actually moves markets today. We know, I mean, I think the answer I basically gave or tried to give on oil and copper was, well, we know the end journey in where these things are going to be because of all of the infrastructure spend that is necessary, because of the only way out for governments is to actually rebuild their infrastructure. And that means, you know, they're going to need copper, they're going to need energy, they're going to need materials, they're going to need all sorts of stuff. And that just effectively means that prices won't be going down, they're more likely to be going up. So longer term, you think there's like a commodity boom, but you have to trade today. And so, you know, if you were looking at copper or oil or leading indicators from 6 months ago, 9 months ago, they're all saying to you, it's a lot of problems going on out there. So surely something's going to break. And
yeah, that's why I'm speaking to you, because what am I doing? I'm rationalizing my super bearish equity view here. That's why I asked last week, Dr. Copper, shit.
Oh, no, not
energy prices, shit. You just mentioned leading indicators. Just before we started the conversation, I don't want to look stupid talking to you. I opened the conference board website again and looked at the leading indicators. An absolute fucking catastrophe. Yeah? 2 versus 10s. It's getting steeper now. A surefire indication that equity markets will have to bump. Bond markets in Europe, you hear the system crackling a little bit. Yeah, Italy is not getting revalued. They're playing games in Turkey and in Greece at the moment. And then the big 600-pound elephant or gorilla in the room. Last week, McCarthy said, "Oh yeah, I can see we actually U.S. debt ceiling. We can come to a conclusion. The right people are now in the room talking to each other." He said that until Friday, the option expiration was over. And the markets were like, yay, equities, go, for whatever reason, be long. Yeah, because there is Chartist 101. Yeah? Everybody in the retail community has seen that now. You simply connect the 2 low points, a low and a lower low, put a line through it, then you put a parallel line through it through the highest point, and then you have a channel. This is now all over the internet, people explaining it, something, well, everybody looked at these channels forever. You have them on your screen. We've now dipped above this little bit, and suddenly you saw the buying frenzy going in. Fundamentals, people are firing people. High-tech industry is still firing people. And the big elephant in the room, the trade, I want to go to that. On Wednesday or Thursday next week, NVIDIA comes out with figures. Yeah? NVIDIA, I went short at 290. I explained it last week. What did I do? I saw the new 290 call and bought at 295. So my risk was $2.50 per share to the upside, $2.50 to the downside. Yeah? Nothing really happens. The stock rallied to 315. Yeah? Fine. So if you were just the poor schmuck who traded it in equities, you would have been out of pocket $20. I'm out of pocket $2.50. I like it actually, because now I can sell it even at a higher level. Because what is the market expecting? The rally is happening before the numbers come in. With all these things we just discussed, leading indicators, bond markets, friction everywhere in the system, debt ceiling coming up. If they don't deliver numbers, and especially, well, nobody gives about the numbers. Yeah, they're being revised down, then you beat them, and you've beaten expectations, even if they weren't that good at all to begin with. But if they don't deliver guidance, being carried in by Tinkerbell and fairies, telling them that AI in NVIDIA is going to take over the world. We've seen what happened to PayPal. Good numbers, boom, complete bomb out. That's the scenario we are in at the moment. As I started, I'm rationalizing. Yeah? I'm looking for reasons why this dump feeling or it's going through, where is it coming from? That's why I called this video, something is going to break. Something is going to break. But I don't know whether I'm going to get screwed and it's going to the upside, or we're actually going to see this big collapse, which I expect there's time to, and I'm not talking about the end of times here, but sometimes market also need a breather to come back to the scenario we're in. I know right at the beginning when we started these conversations, you said main point is liquidity, and liquidity doesn't look bad for the markets. That is now, after this long monologue, the next segue, US debt ceiling. If they broker a deal, the Treasury is still short of money. They'll have to issue a lot of paper. What's the impact on that on the market? Isn't that taking liquidity away, or is that providing liquidity to the market? I really haven't understood it.
Yes, I'm sorry. Okay, so just again to deal with that, your last 5 minutes there. So what do you focus on? I think, before we get onto debt ceiling and liquidity and all of this stuff, the reason I brought up oil and copper, yep, and you discussed about leading indicators. And, I watch a lot of golf videos, I must say. I mean, that's just my sort of pastime, as it were. To the left, I've got the golf video talking to me about chipping and the long game and all of this stuff. And on the right, I've got the YouTube videos, and they're all, stock markets to fall 20%. This is the end of this is worse than the 1929 crash. And it keeps going on and on and on. I mean, there's a lot of depression out there, and I mean it's great for people who kind of want to get confirmation of the view. And I think there's a lot of people who like to see stuff like that, and it's okay. But at the end of the day, like the copper story, like the oil story, you basically have to say, is this something which predicts a market for me for now? Or what is the prediction time horizon on oil? When is the correlation oil and markets or copper and markets very high? And when is it, over what time period is it actually really poor? And over a short time period, so 6 months or something like this, forget it. It will tell you nothing. And latest thing I saw this week was the Chinese yuan is collapsing. Well, it's been collapsing for a while. Yeah? I mean, so this is not just because it crossed 7 against the dollar. You need to think about these things in advance and understand what they mean. And so if you just notice that the Chinese currency is going down, well, then you wouldn't have figured out, what's going on with their economy and why they are continuing to pump liquidity and why it is necessary for the Chinese to make sure that they get out of this thing. And it comes down to, and it joins in with a story about the debt ceiling, is if something breaks in a world where you've got debt to GDP for every country, it's bloody high, right? Apart from some emerging markets, for the countries that we all talk about, when the debt to GDP is so bloody high and something breaks, what happens? Then you risk a sovereign default. And that, you say, oh, no, it can't be a sovereign default because I'll print. Well, there you go. You're back to saying, I have to avoid a sovereign default at all costs. Not everyone is the reserve currency. So, what did the Brits do? As soon as there was a budget which the market didn't like, and they sold the gilts, and potentially the bond market was cracking, something's going to break. What did the Brits do? So a couple of days before, they say, we're going to do quantitative tightening. And then 2 days later, they say, oh, we need to put some money in. But this is not quantitative easing. But they're adding liquidity because the governments cannot let their bond markets go. If they let their bond markets go, so McCarthy and Biden and whoever else is involved in the sort of theatrics about, if you think about how much they are actually discussing right now in the greater scheme of things, it's tiny. So if they really want to screw things up for the Americans for many years to come, then they should carry on doing what they're doing. And the smart people in the background are saying, for God's sakes, come to a deal. If they don't, then it's problematic. It means that you are going sort of beyond. But sort of the thinking that I would say people like me have is to say, well, governments realize that A, they won't get elected if there's a recession, right? So step number one. Number two, it doesn't really help their budget deficit. So everything they are negotiating about today will be lost and more in the higher interest costs that they will be forced to pay as a result of them defaulting. So all governments with a very high debt to GDP ratio above 100 and whatever it is, and you know, in some countries 200 and so on and so forth, they have to protect the future. They have to encourage growth, and even to the point where you say, you know, commercial banks create the money and they sort of get the economy moving, and then the central banks stand behind the commercial banks. And then we had this 2008 financial crisis. So the central banks kind of took on a lot of the responsibility for all of the cock-ups, if you like, that went on beforehand. Well, now the central banks are they're in control, but the governments are standing behind the central banks and they're saying, well, hang on a minute. You know, you may be in control of all of that stuff, but we still want to get elected. We still cannot accept an economy which will decline. And that's why I say, what's the thesis? The thesis is they have to continue to print. They have to have real interest rates negative. In other words, you have to set an interest rate below the true rate of inflation, right? And in order to get the debt to GDP down to a certain level that is acceptable, that's not going to be done overnight. That's going to be done over a number of years. And in the meantime, you know, they've got wonderful things to invest in. They've got this green energy thing. They can sort of start to, as we say, help banks to sort of lend money in this. So back to debt ceiling, you know, what happens on liquidity? Well, I mean, that's absolutely right. What you're saying is, so there are, if you like, there are three broad elements of the liquidity kind of formula. One is the balance sheet of the central bank, and the other two bits. So the balance sheet of the central bank is the thing which adds liquidity when you increase it. But the things that take away liquidity are the Treasury General account and the reverse repos. Reverse repos is basically what the money markets have effectively been, funds have been investing in. But it's been fairly static at about 2 trillion over the last 6-9 months, maybe longer. The Treasury General account is the problem area that I think you're focused on, and that is to say, well, that has been run down. That's what is a Treasury General account. It's basically the account of Janet Yellen. So that's where she pays money out, entitlements and whatever else, and she gets tax receipts in, and then she has money in the kitty, and then so she can deal with spending and stuff from that account. And normally there's about $500 billion in there, right? Like you'd have probably, you know, let's just say 500 quid in your bank account just in case you need to go shopping. Well, your 500 quid is her $500 billion. And at the moment, that's really bloody low because she's been running it down because you're not allowed to borrow in the markets. And so you're saying, well, once they agree, she's going to top it up. Where does that money come from? It comes from the markets. Then you're draining liquidity. And in the meantime, the Fed are doing quantitative tightening. So if she's draining liquidity, surely that's bad for the markets. Absolutely spot on. However, if she,
I love the howevers, Nick.
Yeah, I mean, I should be a lawyer. So I talked about the reverse repo account, and it could well be that you just simply see, you know, switching from, you know, one account here to another account here, both effectively neutralizing the effect of the liquidity thing. So that's first thing. I mean, if they borrow 10-year money, if she borrows 10-year money, then obviously there is no chance for the money market funds or the reverse repos to deal with that. So therefore, that will be a drain. So it's the first thing is to look for what maturity is Janet Yellen looking to borrow her money. So if it's short dates, you're okay, most likely. The other problem that comes, what about the drain still from the ECB, and what about the drain from quantitative tightening? And I just repeat my fundamental thesis, and that is they cannot afford to see markets go down. There's a huge correlation between tax receipts and the level of stock markets, and this relationship has been in place ever since Clinton almost changed the rules on, what is deductible in the expense item for companies in the States and what is not. So that there is a very, very close link between tax receipts. And for that reason, they've got to see this thing, they've got to keep pumping and they've got to keep printing. That's my thesis on this. And it's held well, I don't get fazed when I see oil go down. I don't get fazed when I see copper go down, but sooner or later, some things, it may well matter one day.
Let me kick in there, because obviously I was trying to push you elaborately into my trap. Well, I thought, okay, there are two ways. The whole thing, the debt ceiling blows up, and if it doesn't blow up, they will extract liquidity out of the market. That's one part. I heard a brilliant political analyst. He was going into said, okay, Thorsten, think about incentives. What is the incentive for McCarthy and what's the incentive for the Democrats in this whole discussion? First incentive is they want to keep their jobs. It's not about doing the best for the American people or for the world financial markets or being able, they want to keep their jobs. McCarthy is in a bit of a pickle because he has the whole MAGA crowd. He won after 3 or 4 or 5 elections, the leadership for the House. So he's already painted into a corner. He can't really piss off the MAGA conservatives they have in there. So that he's going to bend is very, very unlikely. On the Democratic side, assuming that the guys who really run the show don't like Biden running the next election, what would be the best way to dispose of him? Let this whole thing blow up. That will surely get a new guy in who can then fix the problems and everybody will be happy. It's not going to be a geriatric who at the best of times barely knows where he is running the show. You can get a new face in and everything will be hunky-dory. Keep that in the back of your head. That is one point. It could blow up. The other is it will drain the market of liquidity. And the third point, coming back to your golf, is obviously I'm always being asked, and I always have to smile a little bit about that, because usually I said to my students, Thorsten, how can we make money? And I said, you want to do what the other guys do, but you want to do it earlier. Then your investments usually work. You outthink what the other guys are doing. And the moment you say, okay, there are a lot of contrarians in there, or it's almost a default position. Yeah, but everybody is talking about a crash. What I say is, let's take the crash out of the equation. But to get a negative market, a bear market, a lot of people have to be the opinion that it's not worth buying risk equities or risk assets at the moment. There has to be a consensus that it's nicer to sell it now and buy it back at a cheaper point in time. Only then you can actually get a bear market in normal conditions, until you have the complete blowout stages. Is everybody's foaming about their mouths on the top of the market or at the bottom of the market? Fine. But in the meantime, to have a declining market, a lot of people have to agree that it's not worth investing in these equities. And then we're coming back to the data points. Yes, I see these data points, and yes, I see your thesis, but what am I supposed to do? I see all these things I've just lined up, from economic indicators to copper to oil. The only thing that doesn't hold at the moment, my line of argumentation, is the equity market, because the equity market is not doing what I thought it would do. So you might be right after all, and all these data points might change. I'm early or I'm too late in this game. We already had our recession. We had the 20% decline in the S&P last year. That was it. But at the moment, I'm still standing there and say, okay, fine, I see all this friction. In my playbook, there has to come a correction.
So let me give you an analogy. So as an advisor, so I advise people, right? Yep. And so I might give them a thesis and say, look, that's the general direction, but I've got to steer you to that goal, because we're going down a road, and sometimes that road is going to be slippery. Sometimes it's going to be, you won't be able to see ahead of you. Yeah. Sometimes you've got to do a sharp left. And we've got to steer, our clients to the end goal safely. we can't say, well, the end goal is up there somewhere. But it's sort of to the right and over there. You can't say, well, they're not going to turn right now, because there may be a cliff underneath where you try to. So you have to say, okay, timing is everything. That's why charting is something that you have to use together with your thing. So effectively you said, oh, well, some people have drawn some channel, we've reached the top of the channel. My own sort of view on the S&P is, yeah, I mean, it's got room to fall, 100 odd points, 200 points maybe. It's not a collapse, it's just a retracement, it's okay. A bit of bad news, doesn't sort of, Fed come in, they do some stuff, and it's okay. And we can survive that because that's just a little bit of a skid down the road. You told me last week that the option, or was it 2 weeks ago, you said the option volatility is very low. So therefore, maybe it's a good time to buy or have bought some cheap protection on stuff like this for situations that might occur. It's like buying some, special insurance on the car, to have your, someone else drive it for a bit. And that's what you've got to do, right? And that's the analogy of what do you do, and coming back to an investment process. So let's just say you're old school, right? And you say, this liquidity stuff is just not what I'm made of. I understand oil, I understand copper, I understand leading indicators, and those will be the things that drive my view as to, let's just say, and I know you follow the quadrant approach, and say, okay, I still believe we're going to head into that deflation box, and deflation means assets are going to collapse, and I need to sell some stuff. And I say, okay, so what does well in a deflation box? So it's the US dollar. My own personal view on the US dollar is 100 is a low, 106 will be the high, so we'll probably sort of gravitate our way somewhere towards there. So the dollar does well, treasuries do well. What's the chart look like on treasuries? Is this the right time to buy treasuries? What part of the curve do I want to buy in treasuries, debt ceiling and all of that stuff to be discussed? What does bad, or which sectors of the equity market do I want to buy? Which sectors do I want to sell? And what does the chart look like on these things? So even with a view that, let's just say, is totally different to what might be a better predictor. So even if you have a view which is, not quite sort of, telling you where the markets go, but by looking at the individual components of your, quadrant, if you like, you can actually work out and say, well, actually, the best trade for me would be to do X, Y, and Z, even with the view that I have got, because let's just say, because of my view of deflation, what is it that's going to go down? Energy. You'd be right on that. You'd been selling energy up till now. It's been, an awful performer in the markets. You say, well, real estate, commercial real estate, that's going to get hit. What's actually got trash? Commercial real estate. Regional banks, so you've had the opportunity to play that deflation game let's just say you can even get away with the wrong view just by sort of thinking logically what also might play out. And that's something that, when I discuss with clients stuff like this, they're always going to have a different view to you. Yeah. And they're always going to have a preferred way to play things. You say, okay, well, what would be consistent then that actually allows you to make money in such an environment? And that's basically how I would sort of work with someone like yourself. And
I agree with you. The sectors you just mentioned are absolutely consistent with your view and with my view, actually, on the data. Yeah? We've seen that. The only thing why, obviously, the S&P, my pet hate in there is it's not doing what it's supposed to do. And it's not doing it because we have the big fives who are dominating the market, and they are tech sector. And tech sector, the grid you just described, is not what you want to own.
Yes.
In this environment. So we agree on the environment, we agree on the defensive sectors, or where you should invest or divest. What I'm actually waiting for is, and that's again, that was one of the conversations we had before between tactical and strategic. I expect that this whole tech malarkey actually will see a bloody correction because it doesn't fit into any of these frames we just described.
Okay, but if I were talking to you as a client, I'd say, yeah, but hang on, we've got already some other sectors here that have proven themselves. I mean, obviously you don't want to sell the low. So if you haven't, you know, if I haven't spoken to you in the last months, then, you know, this is the wrong time to tell you to do something like that. But let's just say, you know, I've got you convinced and, you know, you've been positioned and, you know, now it's about sort of where do you take your profits and stuff like that. But when, you know, it's like the time you spoke to me first about NVIDIA and I, you know, totally caught me by surprise and I just put it up on my screen like, so, you know, I have a tool. I've created a tool where I can just basically say, no, leave that alone.
Yeah.
And that's exactly what you've got to do. So you say, okay, you're waiting for tech to break. So I would say, then wait for me to tell you when it's going to break. Now, you may not be the sort of the first 5% of this thing, but I guarantee you will be able to pick this thing up in time and play this thing in time. So it's on your radar. Let's say it's now on my radar, because I know it's on your radar. But rather sell things where, you know, if you just focus on stuff that's not working, you're just going to miss the stuff that is working.
Yep.
And
no, I absolutely agree on all the sectors you just mentioned. On the tech side, I think, yes, I shall wait while even still being exposed. I'm waiting for higher levels to sell even in the sector. I will follow your guidance there. What we have established today for our viewers, and I think that is very interesting, we've identified all the potential points. We had different opinions on these points, but at the end, what you can see is that the investment process always comes back to the sectors, the descriptions. What is the market actually doing? Which sectors should perform? And you've identified exactly the sectors that behaved within this investment process the way they should, right? We have the odd one out.
Is tech.
Yeah. Is tech.
Probably even bonds, because, you know, if this really was as bad, and, you know, if let's just say your view was the economy is going to head into a recession, the type of recession that's not shallow, the type of recession where the Fed just says, don't care, the type of recession where actually people just sort of panic, get out of stuff. And for whatever reason, you know, there's no one there to sort of stand behind the markets as they have always done, you know, for many years. So in that kind of world, yeah, I mean, you know, that's what you are describing. That's what you are looking for. Where's the treasury bid? There isn't any. What's been going on in the dollar? You know, with all of this stuff, right? With the, you know, the Chinese yuan is falling out of bed. China's going to blow up tomorrow. Well, maybe. But, you know, the last time the Chinese devalued, and it's on my radar, and I've been talking about devaluation last year with my people, but we don't play devaluation. We just, you know, this is a gentle, so far, selling off of the Chinese currency. Why hasn't the dollar started to rally if things were so bad? So the actual, you know, you're focusing on oil and copper as being confirmatory bits of data for you and leading indicators. But actually, if you really look at that quadrant, things are not quite behaving like that quadrant. It's sort of more behaving like kind of the Goldilocks world rather than the, you know, the deflation world.
Exactly.
Or very close to the origin, if you like, of that quad. It's just, there's nothing really sort of taking you to extremes, because the dollar's not rallying, treasuries are not rallying, gold's rallying, but gold shouldn't be rallying where real yields are. So, you know, go with the things that work in that quadrant.
Oh, let me give you, and then we are closing it down, a very highbrow, obviously, to show how intellectual I am, description or analogy of it. It's like a quantum realm we're in at the moment. We have the classic double slit experiment where a particle can be in two positions at the same time until it is observed. And that's what we're having at the moment. We are on the Goldilocks and we're on the deflation quadrant. And we haven't deserved the conditions that give us the final breakdown in which of these quadrants we're ending up. That's why we're behaving a little bit like Schrödinger's cat. We're alive and we're dead at the same time. And well, obviously, it leaves fantastic opportunities for putting on trades if you, my mantra, if you know how to manage your risk, that's what you're supposed to do. Yeah? Don't spend too much on it. And you mentioned the low volatility, and that's why I want to close it. There are funds out there which I find very, very interesting. You can buy these funds and you are assured that you're going to lose money every year, a little bit. What are they doing? They're loading up the tail end in volatility. Every investor says, yeah, I'm going to lose money with this. And it's even their marketing pitch. They come in and say, yeah, if you invest in us, you'll lose part of your equity every year. However, if it blows up the market, you'll make 20-fold, 30-fold, 40-fold returns in this thing. And that just recently came to my mind. There was this one fund, I've forgotten the name, unfortunately, after the Corona crash, who chipped in, deliberately designed to hedge your tail risk. And it took people out of their predicament just by being invested in this little tail hedge with a small percentage of their portfolio. And that would be actually the approach if I had to invest conservative money at the moment, to say, whatever you choose, go and get yourself a nice chunk of volatility, or people who know what volatility does, and load up on that. You don't want to be exposed once the probability function collapses, and we know in which sector we're in. Either you're being screwed on the upside or you're being screwed on the downside.
Portfolio construction. So what you just described, I think I remember the fund, and but the way that I think that they did it was to say they are like 90% always long equities, but they put always a 10% or 5% hedge. And when their hedge works, they make a shed load of money, much more than they would lose from the 20% decline in the equity market. And, you know, this way, they never get all of the equity returns in a year, but they smooth out their returns. And in years where everyone loses money in equity, they make money in equity. So portfolio construction, very important. And that's why sort of there was a hedge fund manager, I forget his name, who basically said, look, a portfolio should be like a football team. And, you know, you need some defensive players and you need some attackers. And if you just have all forwards who all behave in the same way, you know, and I thought that was a very sensible analogy how to describe portfolio construction. But most of the people I talk to, they're either one way, or they're either super bear or they're super bull. And there's no one talking about, well, in this kind of environment, I think this kind of positioning would be the right thing. It's either fully long or fully short, which I think is totally wrong.
Maybe next week we can dive a little bit into the volatility world. I'm publishing an article probably this week at Macro Hive about volatility, one of the topics again, because that is also one of the things I want to spend some time on, actually, because the hedges you just mentioned, who worked in the past fantastically, and everybody who knew the dark art of trading options had various, well, tools, or how do you call it, arrows in their quiver to use. What I've seen now over the last year, suddenly they don't seem to work anymore the way they used to. And I think that is where we should have a focus on next week. Volatility in the bond market, volatility in the equity markets. And I think this topic called portfolio construction is absolutely awesome to shed some insights into what's going on there, especially in this phase of the market. We're approaching now the debt ceiling. Either it's like a storm in a water glass, your take on it, nothing actually really going to happen because they know nothing is going to happen. They can't let it happen. Or we will see something very exciting coming up, and hopefully have the chance to talk on Sunday about it. I don't know how long we've done, Nick, about an hour or something like this. Perfect. Naturally, let me thank you for these insights, and especially, you know, what I really appreciate is your deep knowledge about putting all these bits together and think a bit more over the horizon of the technical trading approach and get us into the strategic mindset. If I can give my 5-cent knowledge into that, how to trade with volatility and get it all set up, I think everybody who is becoming a fan or viewing that for the beautiful German accent and the banter we have, we will keep that on. We will keep on doing that, and I hopefully will see all of you, especially you, Nick, next Sunday again when we put on the next show. Nick, last words.
my last word will be on NVIDIA. There's a lot of good news priced in on NVIDIA, and I had a look at a chart on that for somebody else last night, and I said NVIDIA losing momentum, so rather buy something else. So if you're going to, they have their results. I think it is this week.
I'm a bit of a madman. I've been stopped out on my first trade. Yeah, a tiny amount. My plan at the moment is take a bit bigger risk on the evening before they issue their numbers. Yes, you might say that's a bit of a gambler approach, but as long, what did my colleague say the other day when I explained the strategy to him? He said that is an inappropriate martingale you're employing, and I like the idea of an inappropriate martingale. So I'll be in there, and I think I shall report to you then how things worked out in NVIDIA, how you can even turn a crapper into a profitable trade.
I look forward to that.
Nick, thank you very much. And now let's go to the after show party. Bye-bye to you. See you next week.
Bye-bye.